Welcome to the Perspectives on IBC series, where advisor Chris Tormey joins me in a discussion on all things related to the infinite banking concept. In this educational series, you'll learn the basics of IBC and how you can recapture the financing function in your life so you can gain more control and freedom of your wealth. So welcome to episode 6 in the Foundations of IBC. I'm here with my good friend Chris Tormey. Chris,
Hey, Tom.
welcome.
Thank you. Thanks for having me.
Well, I'm excited about this one. This should be interesting. There's a lot of information. If you just Google, and our friends at Google and search engines, you can find a lot around this topic. But we're going to share our thoughts around it and hopefully give you some insights to help you think more about it. And if you recall from our prior episodes where we talked about one of the rules around IBC is to rethink your thinking. And so it takes some energy, right? Because we often in a world of high speed everything from Amazon Prime to everything, we want everything fast and we want it simple. And sometimes phrases that people say and sort of mantras stick with people. And in the world of life insurance and finance, it's one that stood out through the test of time. There's a lot of people who say this is buy term and invest the difference. And this was coined back by someone named A.L. Williams. And it really shifted a lot of people's thoughts around whole life insurance and certainly opened up the world of active like management of assets and the mutual fund world and all that comes along with it. And you'll probably hear it from the likes of like a Dave Ramsey or Susie Orman, that they're all touting this is the best strategy for your wealth building. So we're going to talk through it and hopefully demystify a few things and hopefully have you rethink your thinking. So Chris, why don't you kick us off? What's your first reaction when you hear buy term and invest the difference?
My first reaction is I've heard that term before many a time. It's been out there in the zeitgeist for decades, as you said. And Arthur Williams or A.L. Williams, he was an insurance man by training. You have to be to sell term life insurance. But he recognized that so many people, in fact, I'd say the majority of people at that time had whole life insurance owned, and no one really had much in terms of stock investments. So his entire strategy was to get people to release that cash value out to him so he could help them invest it into mutual funds and then buy term life to cover, any potential income replacement, which is the traditional, use of term life insurance to cover that period of time where you don't have the assets yet to protect your family, and you need term life insurance, as you and I both advocate, to protect that family while you're still saving and earning and building those assets up for retirement. But Arthur Williams formed Primerica, which was a gigantic, it's since been merged into Citigroup, I think. But it was a gigantic money management firm in the 1970s, and this all came along at the same time as the 401k. So this was part of that great migration out of pensions and dependable growing assets like whole life insurance into the era of plan your retirement for yourself and invest in the stock market. That all happened in those 1970s.
Yeah. To simplify it, right? Because we do like simple occasionally. Sometimes don't need to overcomplicate it. But the message was whole life insurance is way more expensive than term insurance. Just get term insurance, take the difference between the costs, invest it in the S&P 500, whatever stock market fund you enjoy, and you're going to be much wealthier at the end of the day. Right? That's really what it was, right?
Yes.
And so when you peel back, and you and I are advocates of term insurance, there's a time and place for everything, I think, and a lot of financial tools, right, depending on people's circumstances. But term insurance has tremendous value. Certainly for those who are getting started in their lives or families, having term insurance protect against an awful situation where there's a premature death can really help protect families from financial destruction, right? So it is a good place to start. But just like we know, term insurance and whole life insurance policies are different animals, really, right? There's a different lens to it. It shifts away from being a protection only tool to an actual asset that you can build up. And so, Chris, talk about that for us too, because there's a difference between those two, but then how it varies in comparison to just investing in the stock market or S&P 500.
Absolutely. Yeah, and remember that in the age of Arthur Williams, A.L. Williams, people already had that asset built up. There already was 20 or 30 or 40,000 in the whole life policy. And so people at least had the assets that they moved into the stock market. The term is almost used in this day and age before you've saved up anything at all. So, should I start by dedicating 10,000 a year of my savings into whole life insurance, or should I spend $900 a year, 9,000 less than the whole life policy to protect my family during that period where I'm building up assets and invest the rest in the stock market? Well, when you don't have the money saved up yet, it's very, very difficult to invest the rest. And a lot of times what happens is people buy the term insurance and don't save at all. So that's the first question, is what is your savings rate? How much are you able to keep from the income you're making minus those major expense categories, or all the expense categories, but I look at them as taxes, lifestyle, insurance premiums, and debt service. Those are kind of the big four. And lifestyle, you could include college tuition and things like that, which are going to hit pretty hard at certain points in people's lives. But so the first question is, how much am I saving per year? And then the next question is, if you're not, what should you be saving in order to protect yourself for the future? Because we're in a world where we don't have pensions. There is Social Security, but for many people, that's only going to serve 10 or 15 or 20 or 25% of their total cash flow needs in retirement. So once those savings are being generated and you are bringing into your savings world 10, 15, 20% of what you make, which is sort of the number we're all looking for, whether it be the Susie Orman or Dave Ramsey or the way that you and I help people to plan. That's sort of the number you need, and there's math to back that up. But now what? And so buy term, invest the difference implies first save some money, and then second put it into the stock market rather than putting it into a whole life policy. So that's the question that people need to address when they're buying protection on their family and when they're saving for their futures. And the question is risk versus dry gunpowder or savings or an opportunity fund or an emergency fund. What should the proportion be between those two very separate, in my mind, categories of your savings and your assets?
Yeah, and that's why, when we look at it very objectively, it's kind of an apples to oranges comparison in my mind. Certainly when you think about whole life, and it's more equatable to a savings account, something safe, liquid, right, that will not lose versus something you're putting at risk, even though we've been sort of programmed in such a way to believe that, stock market only can go up, right? We know that's not real, but over long periods of time, so safe, you're going to win, right? If you just wait it out. And so we know that they're different animals. They're different types of financial tools, but in the context of buy term investment, they've kind of been folded as equals, right?
Yeah.
If one earns more than the other, well, you got to understand that the markets can create some volatility. And so that to me is a bigger challenge to this. And then obviously the term insurance, which is pure protection, is kind of like renting insurance, right? You're renting this, you continue to pay for it, and hopefully you never use it, versus an asset we're using in a whole life policy where you're paying into it over long periods of time. And it's an asset just like you're owning a home, like you're owning an asset. To me, is a very big difference. And so just trying to kind of put some sort of meat to it as to why this sort of term just doesn't make sense, because you're not comparing the right things to each other, right? And so this is what we're trying to share today.
Agreed. Even in the world of traditional investment advisory, which is a gigantic industry, you, as a client of an investment advisor, you don't go 100% into equities and 0% into safer fixed income type securities like short-term bonds, mid-term bonds, cash proxies like like money market mutual funds. 90% equities, 10% other or fixed income is really the highest proportion allowed. You rarely see 100-0 that an investment advisor would take because of that high degree of risk. So let's say the average person is 70% equities, 30% fixed income and low risk money market mutual funds. And we're not advocating for that. But the question becomes, well, with this buy term invest the difference idea, invest the difference into a 70-30 portfolio? Is that what we're talking about here? We may ask the person who's advocating for that. And if the answer is yes, you say, well, let's look at that 30%. And let's see what that 30% looks like in terms of how it compares to a whole life policy. Because I do think that whole life policies did not go, I know for a fact, they did not go down in 2022 last year. Whereas that fixed income portion of that 70-30 portfolio went down between 12 and 15 percentage points last year. So there's your ballast, your safety net, your 30% that's supposed to be stable and something to reach for if the 70% gets harmed dramatically, which it also did last year. The S&P 500 lost about 20%, the NASDAQ lost about 33%. But your rock, your 30% that's supposed to be in fixed assets that don't go down, went down double digits. So in my mind, rather than buy term and invest the difference, how about buy whole life insurance and invest the difference between that contribution and the rest of your savings into risk, into things that can yield some higher returns, but you're fully eyes open that they could have tremendous volatility. And that could be stocks, but it could be a business, it could be a franchise, it could be other areas that give you that higher volatility, but in the longer run, higher returns. So the buy turn invest the difference seems to imply 100% S&P 500 or 100% stocks. But really, is that really the way to set up your savings? Or should you be looking at risk across a spectrum of things, like you say, a whole basket of different fruits to manage your assets, which you're building up for your future, the cash flow for your future?
Yeah, and even just to your point, the safety arm of whether you're storing money in banks, that thankfully at the time of this recording you could actually earn something with it, but we've seen many years where you get nothing out of your bank accounts, and even the piddly interest you earn is taxable. But this is also, we use it certainly in the IBC sort of space, that we design these policies in a way that you can store additional cash in there through the use of the funny term PUAs, so paid up additions, where you're obviously increasing your cash accumulation building up, but it also increases your death benefit too, right? Yeah. So if you think about term insurance, that is a pretty stagnant amount that stays there for whatever term of the policy. It could be 15, 20, 30 years. And we know inflation will make that less valuable. So this other means to store cash also helps you kind of somewhat combat inflation as things move forward here, as your death benefit increases, right? And this is something that will be good for you down the road.
Absolutely. Yeah. So now we're speaking about later dates and how insurance can work in your favor as you're older, as a volatility buffer. So when your main holdings drop in value dramatically, or you suffer some sort of loss through an insurance claim related to your property or what have you, where should you reach into for money? To have dry gunpowder at all times, to us, makes a lot of sense. And then someone might ask, well, suppose I end up putting too much into a whole life policy, and therefore I've got this large exposure to zero risk or very, very low risk and high liquidity, and the balance is small, equal the size or smaller in risk assets. What then? Well, the answer is quite simple. The insurance policy allows for you to pull cash in order to put it to places that you think will give you double digit opportunity or some sort of profound type return. So you can always balance to lower risk using a whole life insurance policy's cash value. It's the harder part is to get that cash value into the right size bucket to be able to have that ballast, that balance as you grow older. And that term you mentioned, PUA, or paid up addition, what that's essentially doing is allowing you through the contract to accelerate later payments to pay them now. So there are payments that would be expected otherwise down the road, 5 years, 10 years, 15 years from now, that you're getting handled now and able to use that cash immediately. So it kind of fills that bucket up a little more quickly, or a lot more quickly, than a standard base premium would, that you're going to pay until you're 65 or sometimes even 99 as per the structure of the contract.
Yep. Yeah. So another thing that sort of is typically shared as relates to the buy term and invest a different strategy is that most people only need term insurance, or only need life insurance when, say, their kids are younger, right? So by the time you get of age and hopefully you've outlived your term insurance, which the vast majority of people do. So unfortunately, no one, during that, most of those dollars that you put into the policy, you never see back in your world. But then at the time that you end your term policy, it gets can get very expensive to maintain it if you want to maintain it. So the vast majority of people will have that fall off their world, and now they're in a world of self-insurance, right? They build
Yes.
up so many other assets that they're quote unquote self-insured. So Chris, what are your thoughts around this concept of self-insurance?
Yeah, I think that it's very important to build up enough assets through your life in order to, if you so choose, enjoy a life after the career, which, 65 if it's standard corporate type relationship, 67 is the age now for Social Security, full retirement age. So that kind of mid 60s. Well, we're living to 85 or 90 or even older. You're seeing more and more people living to 100 and older. What I'd say is it is important to build up a whole range of assets, absolutely, because then you have more control over your life and more power to direct those assets where you'd like them to go, to either your own enjoyment, your bucket list, or those you love, charities, family, so forth and so on. Should a portion of that portfolio still be residing in life insurance with some death benefit? And I think the answer to that is unequivocally yes, because of two reasons. One is, when a life is lost, it is always, always consequential. Obviously, it's most important if someone's 40 years old or 35 years old and hasn't built up any assets yet, but has a spouse and children, because now the income is completely lost before any assets have accumulated. But even at an older age, there are huge consequences for the loss of a life, the wisdom that they have that they can share with children, grandchildren, mentees, people like that. And the second thing is, as we move through life, these contracts, the cash value reaches up towards the death benefit, but they don't become an equal number until age 99. So throughout that life from 65 to 99, you have a big jump in the value of your total estate. A big jump in the early years, the 60s and early 70s, a smaller jump in the later years. That is going to be able to fill that gap of consequence from you now being gone, either to pay for your affairs, to serve as a memory and a legacy of who you were to so many people. Could even be spent on yourself, because if you have a sickness that's deemed terminal, you could use the death benefit portion to, if you're well enough to do so, to actually enjoy your time with loved ones in those final, 6, 8, 12 months. So I think it's a tremendously important thing to have. I'm so happy that I have whole life insurance, which is life insurance for my whole life. And again, I think that death should never be, it should never be considered unimportant. And therefore, it's nice to have economics fall into the equation when someone passes on.
Yeah, yeah, and it's interesting because even if you ask somebody and even their homes where they have a mortgage, so you're required to have insurance, and so everyone's going to have insurance. But even if they have homes paid off, most people still have home insurance.
Of
They
course.
maintain it, right? In most scenarios, right? Life insurance, given this sort of strategy at the time of whatever age when your kids are older, now it's time to not insure yourself. To me, kind of goes counter to this, and you're more valuable than your home's ever going to be,
Yeah.
right? And so this is and there might be a subtle switch in this as you kind of migrate into retirement. We're going to have a future episode that kind of goes into a lot more detail around this, how powerful this tool can be to integrate with your other assets in retirement. But there is a transition that typically happens, that it becomes less about income protection, but now becomes asset protection. And what I mean
Yes.
by that, if you have this asset protection of a death benefit, it now allows you to unlock the use of your other dollars that you've accumulated, because you can spend them down quite liberally and still have, if there's desire, to pass on an equivalent amount to those who remain after you die. So
Yes.
it protects the assets you're building and unlocks the use of them. And for some people, when they're thinking about legacy, they got to earmark portions of their other assets,
Yep.
and they can't spend them and use them. Well, this is a way to sort of shift that paradigm quite on its side a bit, and on its head, so you can maximize the use of it. It isn't just one tool or another; it's how they work together. And we'll definitely go through in that in a little bit more detail in the future. But just recognize that that's something that is possible if again, if you rethink your thinking or be open-minded about it.
Yeah, it's very, very natural when you retire and let's say you're worth $1 million to desperately want to keep that 1 million as you move forward in time and just live off of the dividends and the interest that's produced by that million. But the dividends and the interest is $20,000 or $30,000 a year. So it becomes, and that'll erode over with inflation over time. So all of a sudden you're living a much lower level lifestyle if your goal, as so many people's, is to maintain that $1 million. If on the other hand, there's a contract in place, a death benefit that replenishes that full million, you can much more comfortably go from 1 million to 950 to 900 and so forth over time. Enjoy your life so much more, knowing that the million will come back on your passing. The other thing I thought of too is just let's talk about Social Security for a second. So if a husband and wife both work through their career and decide to hold off till age 70 to start claiming, let's say they could get as much as $4,000 a month each. So that's $50,000 a year each of Social Security income. Now, when one of those two spouses pass away, half of that income disappears that very day. So the Social Security Department actually claws back whatever their month pay was in the month that a person passes. So if you pass on the 15th of September, they'll claw back 2 weeks of the Social Security check that they paid out on the 1st of September. But now you've got to replace 50,000 a year in my example due to that lost spouse. And typically people who live together, it's the same house, it's the same utilities. Sometimes they're sharing a car. And so it's very, very difficult to drop your expenses in half. Even after the ceremonies and the memories and the legacy celebration, to lose that 50,000 a year in income is a tremendous loss to the household, and whole life insurance will step in to replenish that as well. So it not only replenishes assets, it also replenishes cash flow.
Yeah. No, that's great. A great addition to that. Yeah, and that's why it's important to kind of look at it holistically, because when you, especially with this sort of mantra, buy term and invest at difference, it loses sight of the bigger picture of all your assets and how they work together. And this is just one piece. And you alluded to it, Chris. I mean, this tool, especially in the time of this recording, where there is certainly some worry and a tremendous amount of volatility, that this type of asset, the role it plays is that part of the solid foundation, right? That it grows and without loss, which we know can have a very big impact on your ability to use your assets in retirement. But this is a tool that, and financial tool that only goes in one direction in terms of growth, and it gives you guarantees that come along with it. Now there's dividends that you're eligible for, and those aren't guaranteed, but they've been paying them for well over 100 years, and for the years I've had my policies, I've always gotten one.
Yeah.
So these are all sort of the other aspects of it, as you kind of, to your point, get older, that become even more important, right? To get that, reduce the volatility and get some guarantees and have some certainty, because I know that's what a lot of people get concerned with, and as they're out of their accumulation years, right? Now, how do I ensure I have enough, right? And ensure that I don't suffer big significant losses that are going to really damage the way I live my retirement.
Yeah. Yeah. If you think about it, all insurance is nothing but an expense unless something happens, unless a benefit is triggered, unless you get in a car accident, or a tree falls on your house, or you pass away, or you get sick or injured. Now, the only type of insurance that talks about when an occurrence happens is life insurance. Property and casualty is all about if, right? I sit in a house here, I've mentioned before, that's 105 years old. It's never burnt down. When I sell it and move on, hopefully it won't have burnt down by then, but I'll have paid that insurance all the way through the 25, 30 years that I'm here. But life insurance, it's an if for the term insurance, because as you mentioned, once you get through that term period, the price becomes extremely high. They want to either force you into buying new insurance if you're still healthy, or living without insurance if you're unable to get new insurance. With whole life insurance, it's a question of when, not if. And if you really think it through, as you and I have, there's no other insurance that deals with when, timing, but not dealing with the certainty that something's going to happen, because death is a part of life. That's a certainty.
Yes, there's
So that's why you can build that cash value. That's why there hasn't been any cash value built in my property insurance, because my house could burn down tomorrow. My house might not burn down for another 100 years. So you don't get any cash buildup because it's a question of if. Whereas with whole life insurance, you're contributing to the payout in the cash value of your living needs and the payout of the death benefit when you pass on. So you get both those assets working for you, You get to collect the cash value part throughout your life and use that either through a loan or through a withdrawal. And then you, as long as the policy's still got at least $1 of cash value in it, you get the death benefit at the time you pass on.
Absolutely.
So it's
Yeah.
really a special thing. I do think that it kind of got taken into the whole wave of equities, just like pensions disappeared. For in a lot of ways, whole life insurance became much less popular, and I think that Nelson Nash and the Nelson Nash Institute and people like you and me really think that it's got a huge place for people in this day and age, because there's so much that's got risk embedded in it. It's nice to have a financial partner that's offering you a lot of guarantees, and that's what these mutual life companies do.
Yeah. And the last thing I would say on this, Chris, is, and you alluded to earlier in our conversation, is that even though this tool and in the whole life policy and designed in the way that we know how to design them gives you a good storage bin of money, right? That only grows, is guaranteed to go up, and is tax deferred, and we can certainly use it where there won't be any tax implications, but it also gives you some guaranteed financing to invest in other things that create risk or have risk, right? Whether it be stocks or real estate, to your point, in business. So this is also about how to maximize the use of dollars, right? Because when we go invest in, say, a 401k or put our money in a brokerage account, to invest the rest, it has one job, right? And it primarily is used for that, to accumulate and grow our net worth, but it doesn't get used for anything else, right? It has kind of one really big purpose. And
Yes.
so for that angle to it, is just to open up your eyes to see how do we get our dollars to do multiple jobs for us. And this is a great way to kind of at least have the foundation solid. And then as you explore other areas of risk, that you could still leverage them by using someone else's money and leveraging their assets.
Exactly. Well said. And I'd say, that you can choose to withdraw up to your entire premium amount that you paid in, what we call the basis, tax free. What we advocate for is all the way up into your 60s, even 70s, you borrow from the life insurance company using your policy as collateral. And it does cost. And people say, well, wait a minute, how come it costs an interest to borrow from myself? Well, the answer is twofold. One is the policy continues to grow. So from that standpoint, you have not invaded that asset. That asset continues to grow just as illustrated, as long as the dividends are as illustrated. The second thing is, when you borrow from the insurance company, your borrow becomes an asset on their balance sheet. So you're strengthening their balance sheet for yourself and for everyone else who has whole life insurance. And then for you as an individual, withdrawing from a bank account can sometimes just lead to a tiny bank account. Whereas borrowing from a life policy, because it has a rate attached to it, it tends to be the place when cash flow comes your way from that investment you made or from some other sources, you put that money back as quickly as you can, because you know that it's like that interest rate's almost like an attraction back to the insurance company to pay it off and let it, let just the cash value growth be your value growth at the insurance company, rather than being an asset for them. So, I view that rate as an asset, not as even though it's definitionally a liability. You owe an extra 5% on whatever you borrowed, but it's an asset mentally, because you want to move quickly to get that money back in place. And it really, used properly, it really has a really valuable wealth enhancing, wealth growth type setup to it, foundation built, that just what it does? It encourages good behavior. It encourages behavior to get your debts back down and to get your wealth continuing to grow on a nice, convex, positive path, compounding path.
Absolutely. So we covered quite a bit here, and as we're kind of closing on this one, I think it just reminds me of I like to think in terms of and. How can I do X and Y? Instead of a lot of the concepts that are shared broadly through mainstream financial advice is it's an or question. Do I do X or Y? We like to do both to maximize our wealth, our control, and sort of our wealth. And so this is an area of IBC that really helps to really shine a light on infinite opportunities to do what we want. And so the next episodes we're going to go through how IBC helps to perpetuate wealth to future generations, right? If that matters to you, and I think for a lot of people it does. And so we're going to go through that in a little bit more detail and see how that can help provide wealth and resources for the next generations to really do even more. So Chris, any last parting shots on this one?
Well, I'll just leave you with, in the spirit of A.L. Williams, buy whole life and invest the difference above that.
See if that one catches on.
Yeah, thank you very much.
All right, take care.
Take care, Tom. Bye.
Thanks for listening to this podcast and hope you're enjoying this series on the infinite banking concept. Next up is part 7, using IBC to pass wealth for future generations. In addition to the podcast, I would highly encourage you to get the book, Becoming Your Own Banker by R. Nelson Nash. If you want to discuss how IBC can enhance your financial life, feel free to book a free call with our team. We'd be more than happy to help. Visit perennialpride.com to book your call.